So what is an all-in-one loan? How does it work? Let's talk about it. Owning a home can have a great economic return. What other assets can you lever up 4 or 5 to 1 that are also tax advantaged? It's a great strategy for building real wealth, but buying a home can be stressful. There's a lot to consider: pre-approval, interest rates, closing costs, DTI, down payment. If you already own a home but you need access to some of that equity, or you want to lower your monthly payment, those present challenges as well. Never mind the fear-mongering headlines and doom scroll of economic forecasts. Choosing a mortgage in light of all that can be a tough choice to make. So many options, each with their own strengths and weaknesses, but what's best for you and your needs? Well, that can be daunting or downright overwhelming, but what if it didn't have to be? What if we could go back to the drawing board on home loans and imagine a different way altogether? What if there were a way to use what you have to offset what you owe without losing access to those funds in case you need them? Like, let's say you have $100,000 sitting in a savings account that could be connected to what you owed on your home, $350,000 on your mortgage. If you could combine those accounts and only pay interest on the difference, that would save you more than $650 a month in interest. That's never been possible before. Money that went into your mortgage before would stay locked up in the vault of your equity unless you refinanced. That's why we set money aside for when life happens, for when opportunities arise, or when things go terribly wrong, because we all need reserves. Well, now there's a better way. It's the all-in-one loan. Now, the money you deposit in your bank account can be automatically applied to your home's principal, while remaining liquid and available to spend all the while. No more stressful cash crunch. No more setting aside tens of thousands of dollars. Now we're putting them to work. See, in the all-in-one loan, you can write checks from the equity in your home. You can swipe the debit card at any ATM, transfer funds just like any other checking account, except this is a much more sophisticated checking account. Here's why that's a big deal. In a traditional mortgage, the first decade or more, you're paying way more towards interest than you actually are towards principal. You might have a low rate, but you might have really high cost. Remember, what you pay toward principal appreciates. What you pay in interest evaporates. The all-in-one is different. Since every deposit lowers the principal, you can dramatically shorten the term of the payback. Since every dollar deposited is also liquid, you can draw on those funds at any time. So the paydown looks more like this, with drastic reductions in principal and gradual rises as well. This means this could become your only checking account if you wanted it to. The more money goes into it, the more it's going to benefit you. See, we've been taught to do whatever it takes to get the lowest interest rate, but you need to consider actual interest cost. In the all-in-one, interest is calculated daily on that day's balance, and every dollar not spent on bills remains in the account, weighing down the amount owed with compounding effect on interest savings. Look, the all-in-one makes most mortgages look like dilapidated old clunkers. They were great back in the day, like computer science in the 80s, but things have changed, and for the better. Whether it's a primary residence, a second home, an investment property somewhere, the all-in-one can be exactly what you're looking for. People often prefer easy over excellent. In the all-in-one, you get both. We know the all-in-one is not right for everyone, but it is right for everyone to know about. So if you want to learn more, see if the all-in-one might be right for you, or even get started with an application, then reach out to us anytime. We'd love to help you out at aio.loan.